If the AI bubble pops, trillions in paper wealth can vanish, but your plan doesn't have to. Three red flags are flashing right now, and they'll decide whether this boom becomes your opportunity or your regret. Before we dive in, subscribe and turn on the bell so you never miss clear, actionable breakdowns. This is Money Studio, where we decode the market so you can make smarter moves. Imagine starting in 1998, riding dot-com euphoria, and then losing 80% when the crash hit. Today feels similar, not identical, but similar. The names changed. The pattern didn't. Seven giant companies now steer much of the market's direction: Amazon, Microsoft, Alphabet, Meta, Apple, Tesla, and Nvidia. Together, they represent a massive slice of the S&P 500. When leadership narrows like this, expectations harden, and any earnings miss from just one heavyweight can shake everything. Dominance and fragility can exist at the same time. At the same time, an AI Capex arms race is underway. The biggest players are pouring breathtaking sums into data centers, GPUs, and cloud infrastructure. Autonomy, smarter assistants, generative tools, supercomputers. Hundreds of billions of dollars are being committed in a single year. That spending is supporting growth today. But Capex only works if returns arrive soon enough and big enough. If the cash flows lag while investment accelerates, multiples compress and confidence fades. There's also a feedback loop that investors should understand. Chip makers sell the shovels. Cloud providers lease the land. Model companies do the digging. Money flows around that circle. Funding becomes revenue. Revenue becomes valuation. Valuation justifies more funding. It's all fine when profits follow. But if profits don't show up quickly, you can get a loop where money validates money and reality blurs until it doesn't. Another speed limit is the so-called data wall. AI surged by feasting on the public web, but you can't eat the same meal twice. By the late 2020s, we may face scarcity of fresh, high-quality training data. Progress could slow unless the data source changes from scraping to real-world interaction. Proprietary datasets and new forms of synthetic data that actually improve outcomes, rather than just inflate models. The climb has looked vertical. A plateau is possible. So is this a bubble or a breakthrough? The balanced answer is this. Unlike many dot-com darlings, today's AI clearly has utility: coding assistance, content generation, discovery, search augmentation, workflow automation. There is value. The real debate is about the timing and magnitude of profits. If monetization lags while spending soars, the market can re-rate downward. If monetization hits escape velocity, we could see another multi-year supercycle. What can a smart investor do now? First, keep investing broadly. Automate contributions every month into low-fee, broad index funds. That way, you participate in the uptrend and buy the dips without emotion. Compounding works best with consistency, not perfect timing. Second, protect the downside through diversification. Balance growth exposure with ballast bonds for stability, gold and hard assets for shock absorption, income real estate, where it fits, and only a measured slice of speculative assets like crypto if it truly matches your risk capacity. You don't need to predict the exact path of AI to build a resilient portfolio. Breadth beats bravado. Third, raise your cash flow. Your income is the fuel for wealth. Salary moves, skill upgrades, and side hustles give you dry powder when fear is loud and prices are soft. Fortify the engine that funds your long-term positions. There are also clear tripwires to watch. First, leadership stumbles, missed earnings, or softer guidance from the giants. Second, Capex pullbacks, projects paused, data centers delayed, or GPU orders trimmed. Third, credit cracks, AI-linked loans souring, or private credit retrenching. Fourth, regulatory shocks, privacy, safety, IP, or antitrust rulings that throttle scale or raise costs. Fifth, energy and power constraints. If electricity and grid capacity lag demand, the economics of training and inference get squeezed. If a shock hits, remember this: bubbles punish leverage and reward patience. If you are broadly diversified and steadily adding, corrections become inventory, not catastrophe. If you are concentrated and overborrowed, the market becomes a margin call. Avoid complexity you don't need. Stick to processes you can execute under stress. Zoom out and reclaim your edge time. Compounding doesn't need hero trades, it needs discipline. Don't chase every new ticker. Own the market core, tilt toward quality. cash generators, and let time turn volatility into opportunity. The crowd focuses on the next quarter. You focus on the next decade. Here's a simple personal playbook. Automate contributions so you never negotiate with yourself on bad days. Diversify sensibly so one theme can't sink your future. Hold some cash for optionality and unexpected bargains. Write down your rules for adding on weakness and trimming on euphoria. Harvest fear, not headlines. Also, separate stories from cash flow. Great narratives don't always equal great returns. Track real monetization levers, pricing power for AI services, enterprise adoption that sticks, compute costs, trending down, and unit economics that improve with scale. When those move in the right direction, the story becomes a business. Finally, decide what kind of investor you are. If you want broad exposure, the index already gives you the winners without picking them. If you want selective exposure, ask one hard question before you buy. If growth slows and multiples compress, would I still want to own this? If the answer is no, you're speculating, not investing. That's fine if it's intentional and sized appropriately, but know which game you're playing. Whether AI becomes a boom that compounds or a bubble that corrects, resilience is a choice. You can't control the cycle, but you can control your system. Keep it simple. Keep it steady. Keep going. This is Money Studio. Subscribe, like, and turn on the bell for more daily insights on money habits, investing, stock market, economy, explained, global markets and trends.